Hello, everyone. I hope you're doing well. Today, we're going to be covering velocity banking and how it works. Now, velocity banking is known under many different names. Velocity banking is kind of like the truth and equity concept. It's also known as paycheck parking in some circles. Essentially, it is used in a method whereby, rather, you use a revolving credit product, usually a line of credit, LOC, okay, to take advantage of how interest is calculated on a line of credit and how you use your cash and your income in order to ultimately reduce your interest costs over the term of any loan. Really, today we're going to be talking about mortgages, but this literally applies to anything. So let's look at the basic concept of this. Let's pretend, okay? Let's throw some numbers out there. Let's pretend you have a $10,000 line of credit. The interest rate on this is, say, 10%. You have an income of, let's say, I don't know, $4,000 a month take home. And you have a mortgage. So let's say it was a 25-year mortgage. And I'm going to be tabbing out here because I have all of this written in another window. 25-year mortgage, $300,000 principal amount was owing initially. Your interest rate on this is 2% interest, and you have 20 years left. 20 years left. Okay. So, yeah, does this all make sense? Perfect. Okay. So the theory of velocity banking is very simple. Let's go through an example. So, imagine if you have a line of credit with a $4,000 balance owing on it. Okay. And you pay, so balance owing, and you make a $4,000 payment onto this line of credit. What's the new balance? Okay, well, it's going to be $0. How much interest is charged on a $0 balance? Well, of course, it's $0. Okay, so we've got the basic principles out of it. So essentially, the velocity banking process, instead of rather, I'm going to take a step back. It changes the way that you go about spending your money. Most people, what they do is they take this income, they put it into a checking account, and then what they do is they go and they make all of their various payments all over the place, right? So, they've got obviously their line of credit payment that they would typically have. They would have, their rent, their mortgage, their etc. payment that they would have to make out of this. All the velocity banking process does is simply changes where this money goes. And so rather than it going into this checking account, what ends up happening is you take your income, you put it into your line of credit, which effectively makes the balance zero. And then you simply go ahead and spend your money appropriately out of this line of credit. Now, to ensure the efficiency of it, essentially what you try to do is you try to consolidate as many of these payments as possible on a credit card, and I'll explain this in other videos as to why we do this, but as many of these payments as you can to keep your average daily balance low. So the reason why this works is because the line of credit interest is charged based upon the average daily balance of the amount of money you have in there. And so what this means is that if for 90% of the month you can keep your balance at zero, let's say, and theoretically, you can make it more than 90%. You can make it almost 99%. Your effective interest costs will be next to nothing because of the fact that your line of credit was effectively at $0 this entire time. Now, in this example, I've said that there was a $4,000 balance, but really what this will allow you to do if you have a free and clear paid off line of credit, or even if you don't, this will still work, but you just have to be careful, okay, is that you have a line of credit, you go ahead and you withdraw, let's pretend $4,000, okay, you apply it against your mortgage, alrighty, and then what you do is you take your income, you deposit onto the line of credit. So you take your $4,000 income, You apply it to your $4,000 line of credit now, which makes the balance zero. You might have to adjust your numbers and where and how things come out, but effectively you should, on a 30-day billing cycle, be able to keep your line of credit roughly at $0 for 28 or 29 days out of the month, which means that the interest charge that you would get paid on this line of credit on a monthly basis would be in the pennies range. Because remember, it's 10% a year, which means that if you held this for the year, you'd get $400 of interest. But now that we're only holding it for maybe 12 to 13 days, say 12 to 24 days out of the entire year, your overall annual interest cost might be, say, $40 at the most. Okay. So now you've got this $0 line of credit. Now, what did this one $4,000 payment do on our 2% interest mortgage? Remember, our line of credit's at 10% interest, but that shouldn't matter because our balance is zero, of course, right? But this single payment, one time, assuming you've only done this once, saves $1,936.97. This is absolutely massive. This one payment means you've paid off this mortgage 4 months earlier. And how much did this cost you? It cost nothing, not a single penny. And if it did cost a little penny, it would be very, 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 very minor. Okay. Now the question becomes, okay, well, wait a second, Dave. I need to go and spend my money. All right. Well, ultimately, yeah, you're still going to have expenses. And the only way this works, by the way, is if you have positive cash flow, which means that if you're spending more than you earn, this will not work. In fact, this will make your situation so much worse. So do not do it. All right. Oh, and by the way, I'm not a financial advisor, not a financial planner, not an insurance agent. I just like finances and I like teaching finances. Okay, that's my disclaimer. Consult professionals. All right. So now that you've got this $4,000 amount that you need to go and spend, well, ultimately, if you're able to keep it, so let's say you deposit your income here, right? So you spent your money, spent the 4,000. You deposit your money here. So now your balance is at $0, right? Because you've spent it, deposited, it equals it out. You want to not have any expenses, or at least have all of your expenses on your credit card. Okay. At the end of the month, you're going to pay off the credit card, set it up so that your main bills, your mortgage, all the things that can't come out of the account, all come out at the end of it on the 28th, 29th day of the month. And then your income will come right back in. Boom, you're done. You've recycled everything. Now, you're not going to be able to take another lump sum payment and pay this off. It depends on how much positive cash flow you have. If you have, say, a $500 a month positive cash flow that you can put towards this, then you're typically talking about what? But it's going to be about 8 months. How often you can do this, because 1 month, right? So let's look at this. So if you're positive $500 cash flow, that means that you're going to have $500 free, essentially sitting in a bank account, right? So there's a couple ways to do this. Is every single month, because you can now borrow an extra $500, you now make another additional $500 mortgage payment onto the the mortgage or whatever debt you're trying to tackle, or you just simply accumulate it into a bank account, and then every 8 months you go ahead and you've got $4,000 sitting back in your account. You go borrow another $4,000 from the line of credit. You go pay off whatever debt you're trying to tackle, whether it's mortgages or whatnot. You take the income that's sitting in your checking account, you pay it off, it equals zero. You've spent nothing to save 4 months on your mortgage, $1,936.97 of interest. And you can do this every 8 months. In this example, if you were to do a $4,000 payment, let's pretend once a year, okay, you have saved $13,000 of interest, and you've paid off your mortgage 4 years and 9 months earlier than you otherwise would have, without spending a single penny more. You have to realize that you have not spent a single penny extra from what you are able to do. All right. You can speed this up and make it better, just because in this example here, you're looking at not spending any money. Sometimes spending a little bit in interest does make sense. And the reason why is because your effective cost of interest is low. I'm going to explain this in a future video, though. because this is complicating enough. But at the end of the day, let's explain this very briefly. If you have a line of credit and you borrow $4,000, you have a $4,000 balance. If you paid interest on this at 10% interest, your interest cost would be $400. If you go ahead and pay off this $4,000 with your $4,000 a month of income, your balance would now be $0. And how much interest at 10% do you pay off? Do you pay rather on a $0 balance? Well, your interest charge is $0. If this line of credit is paid off and you borrow this and put it towards paying something else off, you are eliminating debt and interest at the cost of $0. That's the basics of it. So everyone, thank you very much. Please subscribe to the channel, like the video. Let me know what you think. This stuff is complicating. There's a lot of moving components, but ultimately it will make you wealthier. This is not the get rich quick scheme or anything like that. You're talking about the difference between $13,000 of interest over the course of a 15-year period. Is $13,000 over 15 years going to change your life? Nope. But it's sure a whole lot better than doing what you were doing, especially considering that this doesn't add any cost to what you're doing. Anyway, everyone, cheers. We'll catch you in the next video.